Hi, I'm Nick Stebbing, Chief Operating Officer at Fairstone.
My name is Imogen Hambly. I'm a Portfolio Manager at Fairstone. So passive funds or index funds track market indices. So taking a FTSE 100 index tracker as an example, the fund will aim to gain the same performance as the index by buying the same underlying constituent stocks and rebalancing in line with the index. They're very simple in nature. They tend to be very low cost, and performance is quite predictable because you see the performance of an index, you'll know what the performance of your index fund should be. Active funds, on the other hand, are a little bit more hands-on. They involve a fund manager selecting individual stocks in an attempt to beat a specific index. Managers will use a combination of bottom-up fundamental stock analysis and top-down macroeconomic analysis to find what they perceive to be the best opportunities. Now, because it's a more hands-on approach, active fund management does tend to be more expensive. It can outperform, and it can also provide you with an element of protection through market volatility. But it does come with the risk of higher fees and the risk that the fund manager doesn't get it right. Now, across the portfolios at Fairstone, we don't see either one being necessarily better than the other, and often we'll opt to blend the two styles in an attempt to gain the best of both worlds.
Active investing means that there is an individual or a team of individuals who are looking at the market and trying to identify additional returns that they can deliver. By contrast, passive investing from firms such as Vanguard, who are very well known in this space, is focused on having a basket of investments that will follow the specific sector that the portfolio is invested into. Passive investing is typically cheaper, and what we've seen over the last few years is that passive investing has broadly outperformed the average active investor. Part of our role at Fairstone, if you're invested into an active portfolio, is to identify both the areas where there is the opportunity to outperform, and probably just as importantly, the managers who are well positioned to outperform. So active has a role, passive has a role. It's not one or the other. For most clients, some active and some passive is the right solution.